with us right now. He's India Economist with JP Morgan. He's coming back after some time. Sajjid, good morning. Good to have you back with us here. Thanks very much. We have CPI, WPI, trade numbers, etc. to discuss, but I want to ask you very basic questions to begin the conversation today. In terms of your assessment of growth, underlying growth in the real economy, how are we faring, Sajjid, since the last time we spoke? Any change? Are we stalling? Are we picking up pace? What's going on?
I think of growth as sort of being characterized as a kind of a modest cyclical recovery that's underway. I think different sectors are running at different speeds. I think what's clear over the last 3 quarters is the 2 areas where you've got some impetus and some momentum is urban consumption and public infrastructure spending by the government, especially roads. I think it's clear now whether you look at two-wheeler sales, auto sales, consumer durables within the IIP, or even lending personal loan growth, that urban consumption is holding up quite well. This should not be a surprise at all. This is a pretty textbook response to a large terms of trade shock that India experienced over the last 4 quarters. You're also seeing that the government, true to its word, it needs to be commended that capital expenditure of the budget was budgeted at 25%, which was quite aggressive, and they're running above that in the first 6 or 7 months of this fiscal year, particularly in the road sector. So I think those are the 2 areas where you are getting some lift. I think there are drags as well. Rural economy is a drag, both for structural and cyclical reasons. The global economy clearly is growing quite tepidly, and there's no real boost to the external sector and to exports. And private investment, I think you're seeing some signs, but there's no critical mass as yet. So I would say, all told, growth is accelerating. It's accelerating modestly, but I think we should just be mindful of the fact that much of this growth boost that we've got over the last 4 quarters is this massive terms of trade shock. By our estimates, India got a 2% of GDP terms of trade shock from lower oil prices over the last year, and about 2/3 of that has been spent, about 1.3% of GDP. And the point about that is that that's a one-time effect. So in the next few quarters, that will roll off. There will be no incremental growth impact, and therefore the other more organic drivers of growth in India, reforms, will have to pick up and take the place of this oil windfall that boosted growth.
Just explain that point. You're saying that we got a 2% GDP boost, right? And you said we've spent half of that, according to your estimates.
That's right. So 2/3 of that. So our estimates are we got this windfall, right? When oil prices went from $110 a barrel over the previous 4 quarters to about $45 and $50 a barrel over the last 4 quarters, the Indian economy received a one-time income windfall of 2% of GDP. Half of that, by our estimates, was captured by the government in the form of lower oil subsidies and higher oil taxes. So about 0.9% of GDP of that 2% went to the government, which was largely spent because the government's fiscal targets did not change. So that entire amount was spent. We estimate about 0.8% went to households. This was both the fact that inflation, fuel-related inflation came down, opening up some purchasing power, but more importantly, firms passed on a lot of their reduction in raw material costs to consumers in the forms of discounts and price cuts, which resulted in urban consumption remaining strong, and firms kept a much smaller fraction, of only about 0.4% of GDP by our estimates, which is why earnings have picked up, but not by the amount that you would expect given the extent to which raw material costs have fallen. So the bottom line is we got about 2% of GDP in this windfall shock. 2/3 of that, about 1.3%, was spent in the last 4 quarters, which has boosted growth, but that's a one-time effect. Going forward, that will not incrementally add to growth.
So that's actually pretty scary then, Sajjid, because then if this is 2/3 is spent, and so what from here?
Yeah. I think from here, as I said, the more organic drivers of growth need to pick up. The government has been plugging ahead on the reform front. I think over the next 4 to 6 quarters, hopefully we'll see some of that translating into higher economic activity, number one. Number two, the hope is, the rural economy has been a drag for 2 successive years because of weak monsoons. Hopefully next year we'll have a normal monsoon that will give rural consumption a bit of a boost. Hopefully the worst is over on the global economy. US consumption is strong. I think tail risks in China have been avoided. We expect Chinese growth to stabilize and pick up. So maybe the worst is over in terms of manufacturing exports. But the fact is, we can't escape this fact that we got this windfall over the last 4 quarters that has temporarily boosted growth. That rolls off in the next couple of quarters, and therefore we need to go back to brass tacks and move the supply curve out to keep growth at these levels in the coming quarters and years.
Yeah, I mean, roads, power, railways, and we've discussed this in the past, seem to be moving ahead. The individual ministers are doing a fair bit. The last one was the power sector reforms, the Uday package which the government came out with. So that, things are happening there, but is it translating, Sajjid, in that sense, really, to for purchasing power and essentially spending eventually, which will lead to boost to growth, right? I mean, that's essentially the translation. Are we seeing any of that at all, or is still very, very early? It's a few years out, even in these sectors where the maximum work is happening.
There are 2 different translations here. I think the demand translation from consumption is very much a purchasing power story. Inflation has collapsed, oil prices are down, food prices are down, and households have got this windfall that they've spent. I think what you're referring to is that our supply constraints being eased, and the fact is they are. If you look at coal production in the last year, if you look at electricity production, the latest IIP numbers, and if you look at capital goods production more generally in the IIP, there's a lot of noise in the IIP, but if you smooth out the noise, there's clearly a sense here, whether you look at capital goods production over the last 6 months, or you look at seasonally adjusted commercial vehicle sales, for example, that there is a public infrastructure thrust underway. Will it be slow? Of course it will. The translation from the government announcing something to actually spending the money, to debottlenecking constraints on the ground, to that translating into higher capacities is always a 6-8 quarter process. But I think the fact is there is now hard evidence on the ground, both in terms of capital goods production in the IIP, as well as government spending of capital expenditure, that you have got some momentum there. We just need to be patient because the government has followed an incremental approach, and that is going to take time to pan out in terms of infrastructure growth picking up.
Fair enough. The urban consumption boost, which particular areas are we talking about? Because some of the discretionary areas, I mean, autos, for example, is done quite well somehow, and some of the largest auto companies, 4-wheeler manufacturers have been doing very well. Not so much for 2-wheeler makers who are a lot more exposed to rural markets, but we are seeing we aren't seeing any real fireworks in urban consumption as well, Sajjid. Really, I mean, are people really gung ho about buying houses, buying items on which they would have spent, say, 4-5 years back? Not really. I mean, and that's evident. That's evident in corporate results that we get.
I think that's an unfair. Yeah.
Yeah.
So a couple of things here, Prashant. One is that, so I'm not making the case that overall consumption is growing gangbusters like it was 4 or 5 years ago. Remember, that was also a time when economic growth was running at 9%, rural wages were running at 20%. There was a significant reflation of the economy. Fiscal policy was extremely loose. Real rates were negative for 5 years, and we were growing gangbusters for 1 or 2 years, but that was clearly unsustainable growth. So I think that's an unfair comparison. But if you look at the hard data, yes, scooter sales have grown 14% in nominal terms over the last 6 months compared to a year ago. As you pointed out, auto sales in the urban area have picked up. October was quite strong sequentially. If you look at consumer durables growth within the IIP, again, smooth out the noise, there is a pickup. If you look at lending by banks, personal loan growth has been quite strong. So I think we need to reset our expectations. Are we going to get 25% growth, 30% growth? Absolutely not. Not in this domestic and global environment. The question is inflection points. Is there an acceleration in urban consumption? And by all indicators, there is. Why are corporate earnings not reflecting that buoyancy? Well, there are two factors here. One is rural demand remains extremely weak. So in a way, it's dragging down consumption more than complementing it. You know, the fact that the fiscal deficit has been consolidated, minimum support prices have been reined in. Until this year, there was not too much rural infrastructure, meant that, you know, land prices remained contained and there was no wealth effect in the rural economy. Now, on the back of all that, you've got two successive droughts. So, you know, the rural economy is struggling, and I think you're seeing, A, that, and B, the fact that a lot of firms in the last few months, to retain market share, to retain volumes, have passed on a lot of the input price reduction. So don't be fooled too much by the sales numbers. Those are going to be weak, A, because, you know, volume growth hasn't been exceptionally strong, but also because there's been so much disinflation. These are nominal numbers. Look at margins, and by all accounts in the last 3 or 4 quarters, corporate margins have picked up. Earnings have picked up.
Yeah. No, I think that's true. That's true. So, I mean, I think at the gross level, margins, of course, have shown this big improvement because of fallen input prices, and at an operating level as well, margins have improved. Although, I guess, in many sectors, not to the extent that many expected. I mean, competition, and in many sectors, competition has only picked up even as growth is sluggish. So you need to spend a lot more on advertising and things like that. Sajjid, let's just come to the global picture and just weigh in on the export numbers that we got, especially, but from the volume angle. We saw volumes contracting, I think, on exports, not value-wise, 2 months back for the first time. Any sense this time what's happened? The latest data?
So I think we need to be very careful. Yeah, we need to be very careful how we interpret these export numbers, because for the last 6 months, I put the newspaper and have these very dramatic headlines, exports. The world is
okay, I think
collapsing.
Sajjid is back. Go on, Sajjid.
Remember,
can you start again, Sajjid? We lost you there for a bit. Could you start at the beginning?
Reading this very... Sure. I said when we interpret these export numbers, we need to be very, very careful, separating value from volume, separating commodities from manufacturing. Because over the last 6 months, you pick up the newspaper and you get these very dramatic headlines. Exports are down minus 20%, minus 15%. They've been contracting for 8 months. Remember, oil exports made up about 20% of all merchandise exports before oil prices fell. So if that's 20% of your export basket and oil prices have fallen 50%, you're going to get a 10% value contraction no matter what, right? So if you now look at the manufacturing numbers more specifically, what you will find is undoubtedly there has been pressure on manufacturing exports, but nothing of the sort that the headline export numbers would suggest. The pressure has been faced by all emerging markets, both because a lot of our exports are to other emerging markets which have been slowing, even though exports to the US and Euro area have been picking up. So if you look at those numbers sequentially, what you find is there was weakness in July, August, September. I think things have been reined back the last couple of months. So on a year-on-year basis, manufacturing exports, which were degrowing at 12 or 15%, in the October trade report only degrew at about 5%. I don't think we're out of the woods as yet, but I'm just making 2 points. The export weakness is not as bad as the headline numbers suggest, and to the extent that the global economy is recovering, at least the developed markets are doing well, and China is stabilizing. Hopefully in a quarter or so, one should see manufacturing exports pick up a little bit.
So what you're saying is that the volume demand for Indian exports isn't as bad as it's made out to be in the headlines, right? That's what you're saying.
Exactly right, because a lot of our exports are commodity exports, oil and other commodities, and commodity prices have collapsed 30, 40, 50%. Of course, your values are going to be much lower. And what we're measuring every month in terms of exports year on year is the fall in values. So the other point is, we've found repeatedly for India's new exports, engineering goods, pharmaceuticals, IT services, these are very sensitive to global demand, more so than movements in the exchange rate. So to the extent that growth did stutter in the middle of the year, yes, our exports did get hit. And to the extent that growth may be stabilizing and picking up in the next 2 quarters, that actually bodes well for some of the new age exports, given how demand sensitive they are.
All right, fair enough. Let's get to the drivers for demand here. I mean, equity people routinely cite one big driver for consumption to pick up as the pay commission, wage hikes for some 50 lakh plus central government employees and an equal number of pensioners as well. NDTV put out a story saying that the hike could be about 15%. The report will be submitted to the finance minister tomorrow. Your thoughts, Sajjid, on this and what this can do if this is indeed 15%?
I think that's very admirable. I think 15% would be a demonstration of continued fiscal restraint. I think this government needs to be commended. You've seen minimum support prices grow in a very restrained fashion. I think a 15% increase would be well received by markets, because what we haven't spoken about, Prashant, is that the government faces a pretty significant fiscal challenge over the next 2 years. Remember, the fiscal deficit this year, I think, is well on course to print at 3.9%. That 3.9 has to go to 3.5, and 3.5 has to go to 3. So we're looking at nearly a 1% of GDP fiscal consolidation over the next 2 years. Now, if growth were to pick up very sharply and tax buoyancy picks up, that can help, but I'm not sure that's the baseline case. So the challenge before the government is, how do you achieve next year's fiscal consolidation, which is much more than this year, 0.4% of GDP? How do you do so while also increasing public sector wages and pensions? How do you do that while preserving and maintaining public investment? Because we just spoke that it is government spending in roads, railways, that's helping infrastructure growth. So, and how do you do all of that without any incremental oil windfall? Remember, this year, the government benefited about 0.5% of GDP incrementally from lower oil prices, both higher oil taxes and lower oil subsidies. And the consolidation was only 0.1% of GDP. Next year, you get no incremental help from oil, and you've got a larger consolidation, and you've got to increase public sector wages, and you want to preserve public investment. So it's a pretty significant fiscal challenge, and I think, therefore, I'm not surprised that I won't be surprised if any wage hike is conservative, and if that's the case, I think kudos to the government.
Okay, all right, fair enough. The RBI and I read your report on the WPI, the last one. You wrote on CPI as well on Friday, and you said that these numbers won't have a significant influence on what the RBI does in December, Sajjid. You stick with that?
Very much so. I think if you just look at the bigger picture here in monetary policy, the RBI's next target is 5%, 14 months from now, and then 4% in the medium term. If you strip out all the noise, where is underlying inflation pressure, what we call core inflation? It's been running at 5.5% for the last 4 or 5 months, remarkably stable, and it ticked up to about 5.6% in October. And the momentum of core also picked up, 0.6% of GDP. So I think the first point is that inflation, in our estimates, in the first quarter of next year will settle around 5.5%, maybe slightly higher. There is a little bit of concern on food inflation, both domestically because of pulses, but also what's happening internationally. What people haven't realized is global food prices have been extremely benign for the last year. That's helped India's food disinflation. But in the month of October, global food prices rose 4% month on month, and that's the highest in 3 years. Sugar prices have spiked globally, and that also affected sugar prices in both the WPI and the CPI. So the fact that inflation settles at 5.5%, your target is 5%, global food prices may be turning. You've already cut rates by 125 basis points. I think the RBI now has done what it has to do, and we expect it to remain on a prolonged pause.
Got that. We'll leave it there, Sajjid. It's a pleasure speaking with you. Thanks very much for your time today.